There is a ghost that haunts the halls of Wall Street. It's not a specter of some long-dead trader, but a living phantom that walks beside every single person who has ever dared to risk their capital in the grand theater of the stock market. This phantom whispers in your ear when prices are soaring, telling you to buy more, to mortgage the house, that this time is different. And it screams in your face when prices are plummeting, urging you to sell everything, to run for the safety of cash, to escape the fire before you're burned to ash. This phantom is emotion. It is the collective, manic-depressive, bipolar mood of millions of strangers, condensed into a single, flashing number on a screen. For 99% of people, this phantom is their master. It dictates their every move, ensures they buy at the top and sell at the bottom, and ultimately guarantees that their journey towards financial freedom ends in frustration and loss. But for a select few, for those who have learned the secret, this phantom is not a master, but a servant. A deeply flawed, emotionally unstable, yet remarkably useful servant. And no one in history has mastered this phantom better than Warren Buffett. The central thesis of Buffett's entire investment philosophy, the genetic code from which all his legendary wealth has sprung, can be boiled down to a simple, powerful parable. It's the story of a business partner he calls Mr. Market. This is not just a clever analogy, it is a profound mental model, an emotional shield that, once understood, will fundamentally transform your relationship with money, risk, and opportunity. It is the key to turning the terror of a market crash into the single greatest wealth-building event of your life. The principle is this. Imagine you are in business with a man named Mr. Market. Every single day, without fail, he shows up at your door and offers to either buy your shares in the business or sell you his. The catch is that Mr. Market is an incurable manic depressive. On some days, he is euphoric. He sees nothing but blue skies ahead for your business and offers you a ridiculously high price for your shares. On other days, he is consumed by dread and despair. He sees nothing but ruin and offers to sell you his shares for a pittance. He also has another lovely quirk. He doesn't mind if you ignore him. If you don't like his price today, he'll be back tomorrow with a new one. The fatal mistake, the costly error that prevents millions from achieving portfolio growth, is believing that Mr. Market's daily price quote is a reflection of the business's true value. It is not. It is a reflection of his mood. Your job as an intelligent investor is not to be swayed by his mood, but to exploit it. When he's euphoric, you can consider selling him your shares. When he's terrified, you buy his shares from him at a bargain. You use his emotional swings as your opportunity, turning his volatility into your personal ATM. This is how you stop being a victim of the market and start being its master. This is the final promise of value investing. To truly internalize this, to weld this emotional shield to your own psyche, we must deconstruct it. We will explore this principle through 5 distinct pillars, each a chapter in the grand strategy of Warren Buffett. We will begin with the very origins of the idea itself, understanding the parable at its core. Then, we will journey through history, witnessing Buffett apply this mental model with surgical precision during the darkest moments of market panic, the brutal stagflation crash of the 1970s, the shocking one-day collapse of Black Monday in 1987, the world-shaking financial crisis of 2008, and even the unprecedented global shutdown of 2020. In each case, we will see how this single simple idea allowed him to act with calm, rational brilliance, while the rest of the world was consumed by fear. This is not just a history lesson. This is a blueprint for your own financial transformation, a guide to beating the market not by being smarter, but by being more disciplined. Our first pillar is the bedrock of it all, the parable of Mr. Market itself. We must understand not just the story, but the profound psychological transformation it enables. To do this, we must go back to the source, to the man who gave Buffett this idea, his mentor, the father of value investing, Benjamin Graham. The story isn't about a specific stock purchase Buffett made, but about the purchase of an idea that would become worth hundreds of billions of dollars. Imagine a young Warren Buffett in the early 1950s, not the Oracle of Omaha, but a student at Columbia Business School. He was brilliant, obsessive, devouring every book on finance he could find. But the world of investing he was entering was largely a world of charts, ticker tape, and speculation. It was a cacophony of tips and rumors, a place where price was everything and value was an afterthought. Then, he picked up a book, Benjamin Graham's The Intelligent Investor. For Buffett, reading this book was like a religious experience. He would later say it was by far the best book on investing ever written. And within its pages, specifically in Chapter 8, he found the story of Mr. Market. Graham didn't just write down an analogy. He crafted a narrative device to solve the single greatest problem in investing, the human emotional response to price fluctuations. He saw countless people, smart people, lose fortunes because they couldn't distinguish the temporary emotionally driven price of a stock from the long-term fundamental value of the underlying business. They were slaves to the ticker tape. Graham needed a way to create a psychological buffer, a gap between the investor's mind and the market's madness. So he invented this character, Mr. Market. He gave the market a face, a personality, and a severe mental illness. This act of anthropomorphism was a stroke of genius. Suddenly, the market wasn't an all-knowing, omniscient, God-delivering verdicts on your companies. It was just this nutty guy, your business partner, who you had to deal with. This simple story, which Buffett read as a young man, became the foundational anecdote of his entire career. It wasn't about a single transaction. It was about the acquisition of a mental framework. He learned that you don't get your cues from Mr. Market. You don't let his mood swings, whether euphoric or depressive, influence your own assessment of the business's value. You do your own homework. You calculate what the business is worth, its intrinsic value. And then, you simply wait. You wait for your bipolar partner to have one of his fits of despair and offer you a price far below what you know the business is worth. The power of this anecdote for Buffett was that it reframed the entire game. He was no longer playing the market's game of predicting price movements. He was playing his own game, buying wonderful businesses at fair prices. And he would only transact when his emotionally unstable partner offered him a deal that was too good to refuse. This idea, absorbed in his youth, was the seed from which the entire Berkshire Hathaway empire would grow. The underlying psychological principle that makes the Mr. Market allegory so incredibly powerful is a concept known as cognitive reframing, combined with the deliberate neutralization of herd behavior and loss aversion. Let's break this down. Our brains are wired for social proof, for what psychologists call herd behavior. When everyone around us is panicking and running for the exits, our ancient lizard brain instincts scream at us to do the same. In the ancestral environment, if you saw the rest of your tribe sprinting away from a rustling bush, it was not the time to conduct a detailed analysis of the flora and fauna. It was time to run. The ones who stayed to investigate were eaten by the saber-toothed tiger. This instinct is still deeply embedded in our DNA. A stock market crash is the modern equivalent of that rustling bush. The flashing red numbers, the breathless headlines on financial news, the panicked calls from friends, it all triggers that same primal fear. We see the herd selling, and every fiber of our being tells us to join them to avoid being the last one holding the bag. The Mr. Market story is a cognitive tool that short-circuits this instinct. By personifying the market as a single, unreliable, emotionally volatile individual, you change the dynamic. You are no longer reacting to a faceless, stampeding herd, which feels like an overwhelming objective force of nature. Instead, you are dealing with one crazy guy. And what do you do when a crazy guy screams at you that the world is ending? You don't panic and agree with him. You pat him on the shoulder, recognize he's having a bad day, and calmly go about your business, perhaps even taking advantage of his irrationality. This reframe moves the locus of control from the external, the market's price, to the internal, your own analysis of value. It creates a crucial separation between price and value, two concepts that the panicked mind conflates into one. Furthermore, the allegory directly combats loss aversion, a discovery by psychologists Daniel Kahneman and Amos Tversky that earned them a Nobel Prize. Loss aversion is the principle that the pain of losing is psychologically about twice as powerful as the pleasure of gaining. A $1,000 loss feels far worse than a $1,000 gain feels good. During a market crash, loss aversion goes into hyperdrive. Every downward tick of your portfolio is a fresh stab of psychological pain. The brain's natural impulse is to stop the pain, and the quickest way to do that is to sell. Get out. Convert to cash and make the numbers stop going down. Mr. Market helps you override this. The falling price is no longer a direct representation of your loss. It's just Mr. Market's pessimistic opinion. It's his offer. And since you know he's a manic depressive, you can dismiss his opinion as the ramblings of a temporarily insane individual. The pain of the falling price is muted because you have intellectually demoted the source from an objective truth-teller to a subjective, unreliable narrator. This psychological shield is the very core of a successful long-term investing psychology, allowing for the kind of rational executive decision-making that is impossible when you are in the grip of fear. So how do we translate this into a practical, applied mental model? What is the blueprint for installing the Mr. Market operating system into your own mind? It's a three-step process. First, calculation. Second, personification. Third, inaction. Step 1, calculation, is the bedrock. You cannot exploit the difference between price and value if you have no idea what the value is. Before you ever buy a single share of a company, you must do the work to determine its approximate intrinsic value. This isn't about a precise number down to the penny, it's about having a reasonable range. You can use methods like discounted cash flow analysis, look at earnings power value, or even simpler metrics like price-to-earnings ratios compared to historical averages. The specific method is less important than the act of doing it. You must come to a conclusion based on the business's fundamentals, its earnings, its debt, its competitive position, about what a fair price for the entire business would be. Let's say you analyze a wonderful company and determine its intrinsic value is around $100 per share. This number is your anchor of rationality. It is your North Star when the storm hits. Step 2 is personification. This is the active daily practice of the allegory. Every single day, when you look at the stock market, you are not to see charts and graphs and ticker symbols. You are to consciously and deliberately imagine Mr. Market. Give him a face. Maybe he's a nervous, twitchy man in a rumpled suit. Maybe on good days he's bouncing off the walls with glee, and on bad days he's huddled in a corner, weeping. When you see the price of your company, which you valued at $100, has dropped to $80 because of some negative headline, you literally say to yourself, Mr. Market is in a foul mood today. He's scared. He's offering to sell me his shares for 80 cents on the dollar. Conversely, when the market is euphoric and the price shoots up to $150, you say, wow, Mr. Market is high as a kite. He thinks this business is going to the moon. He's offering to buy my shares for far more than they're worth. This daily act of personification creates the crucial emotional distance. It turns a source of anxiety, a volatile stock price, into a source of information about your partner's mood, and therefore, a source of potential opportunity. Step 3 is the hardest. Inaction. The default action for 99% of the time should be to do nothing. You have your calculated value. You observe Mr. Market's daily mood. You only act when he offers you a truly exceptional deal. Does the fact that he's offering you $80 for your $100 company mean you must buy? No, you can wait. Maybe tomorrow he'll be even more terrified and offer it to you for $70 or $60 during a full-blown market crash. You are in the driver's seat. You are not obligated to transact. This blueprint, calculate, personify, and practice in action, is the practical application of the Mr. Market principle. It's how you move from theory to a disciplined practice that builds wealth over time, providing the foundation for true financial freedom. It is a core tenet of sophisticated wealth management, not just for billionaires, but for any retail investor willing to adopt the mindset. To fully appreciate the genius of this approach, we must examine its antithesis, the path of the 99%. What do most people do, and why does it lead to financial ruin? The average investor does the exact opposite of the three-step blueprint. They do not calculate value. They chase price. They do not personify the market to create distance. They merge with its emotions and become one with the herd. And they do not practice inaction. They are addicted to action, constantly trading, convinced that they can outsmart the collective mood. Their journey begins with a tip from a friend, a talking head on TV, or a hot stock mentioned on a forum. They buy a stock not because they've analyzed the underlying business, but because the price is going up. This is pure emotional momentum investing. They feel the euphoria of the rising price, the confirmation bias that they made a genius move. They are, in effect, shaking hands with a euphoric Mr. Market and agreeing with his manic assessment. Then, inevitably, the narrative shifts. The company misses an earnings estimate, a competitor emerges, or the broader market simply corrects. The price starts to fall. Now, the 99% investor is gripped by fear. They have no anchor of intrinsic value to hold on to. Their only data point, the price, is now their enemy. It's flashing red, signaling a loss. Loss aversion kicks in with the force of a tidal wave. They see the price drop 10%, then 20%. They tell themselves it will come back. But the fear is corrosive. They start checking the price every 5 minutes. Their stomach churns. The financial news is filled with doom and gloom. The herd is selling. Finally, they can't take the pain anymore. They sell, often near the bottom, just to make the psychological bleeding stop. They crystallize a temporary, on-paper loss into a permanent, real one. The tragic irony is that they often sell a perfectly good business, one whose long-term prospects are unchanged, simply because their bipolar partner, Mr. Market, had a panic attack. A classic example of this is the behavior of many tech investors during the dot-com bust of 2000. People were buying companies with no earnings and no clear path to profitability at insane valuations, simply because the price kept going up. They were high-fiving a manic Mr. Market. When the bubble burst, they didn't have a valuation anchor. Was Pets.com worth $50 a share or 50 cents? They had no idea. All they knew was that the price was collapsing. The pain of seeing their portfolio evaporate drove them to sell everything, often at losses of 90% or more. They confused the collapsing price with a collapsing business, and in their panic, they failed to distinguish between the truly worthless companies and the solid, world-changing businesses like Amazon, whose stock also got crushed, falling from over $100 to under $10. The 99% path is to let Mr. Market's mood be your reality. It's a guaranteed path to buying high and selling low, a cycle of greed and fear that enriches only the brokers and the calm, rational investors on the other side of the trade. The direct financial connection, the tangible manifestation of this mental model on your portfolio, is profound. Adopting the Mr. Market framework creates two massive financial advantages: catastrophic loss prevention and asymmetric upside capture. First, loss prevention. The single biggest destroyer of long-term returns is not picking a few losing stocks. It's panicking and selling your best companies during a downturn. By having a calculated intrinsic value and viewing a price drop as an emotional offer rather than a final verdict, you prevent yourself from making the biggest mistake in investing: selling a great business at a stupid price. This emotional shield preserves your capital. It keeps you in the game, allowing your quality assets the time they need to compound. On a balance sheet, this looks like stability. It avoids the massive, realized losses that permanently impair your capital base and your ability to generate future returns. It's the defensive play that makes all offensive plays possible. Second, and more powerfully, is asymmetric upside capture. A market crash is a system-wide repricing of assets driven by fear, not fundamentals. This means that for a brief window of time, Mr. Market will offer you world-class businesses for cents on the dollar. Because you have done the work, have your shopping list ready, and have the emotional fortitude to act when others are paralyzed by fear, You can acquire assets at prices that provide an enormous margin of safety and a staggering potential for capital gains. When you buy a $100 business for $50, you have a built-in 50% discount. If the business simply returns to its fair value, you've doubled your money. If the business continues to grow, your returns are even more spectacular. This is how multi-generational wealth is built. It's not from timing the market day to day. It's from allocating capital intelligently during moments of maximum pessimism. On a portfolio statement, this looks like explosive portfolio growth in the years following a crash. You are planting seeds in the dead of winter while everyone else is convinced spring will never come. The Mr. Market mental model is not just a quaint story. It is a high-performance financial engine that transforms market volatility from a source of risk into the primary source of your outsized returns. It is the core secret to beating the market over the long run. Now we move to our second pillar, where we will see this theory forged in the fires of a real-world crisis. We travel back to the tumultuous years of 1973 and 1974. A period of profound economic misery that tested the mettle of even the most seasoned investors. This was a perfect storm of stagflation, a toxic brew of stagnant economic growth, soaring unemployment, and runaway inflation, all exacerbated by the OPEC oil embargo. The stock market, as measured by the Dow Jones, was utterly decimated, falling by nearly 45%. It was a brutal, grinding bear market that lasted for almost 2 years, wiping out fortunes and shattering investor confidence. The prevailing mood was one of deep, pervasive pessimism. The Nifty 50 stocks, the one-decision blue-chip growth stocks that were once seen as invincible, had collapsed. It seemed like the American economic engine was broken, perhaps permanently. This was a moment of peak fear, a time when Mr. Market was not just depressed, but catatonic with terror. And it was in this exact environment that Warren Buffett, armed with his mental model, went shopping for one of the greatest bargains of his career, the Washington Post Company. The foundational anecdote begins with Buffett's long-standing admiration for the newspaper business, and specifically for high-quality, dominant franchises. He understood the power of a local monopoly newspaper. It was the town's central nervous system, the essential source of information, and a cash-gushing machine from advertising revenue. The Washington Post was one of the crown jewels of American journalism, a paper of immense prestige and influence, especially after its Watergate reporting led to the resignation of President Richard Nixon in August 1974. The company was run by the brilliant and formidable Katharine Graham. It was, by any objective measure, a phenomenal business with a deep competitive moat. Yet, in the depths of the 1973-74 market crash, Mr. Market looked at this incredible institution and saw only darkness. He saw rising newsprint costs due to inflation. He saw the threat of a prolonged recession hurting advertising revenue. He saw the political turmoil and uncertainty gripping the nation, and in his despair, he offered to sell shares of this media empire for a price that was nothing short of absurd. In 1973, the entire market capitalization of the Washington Post Company fell to just $80 million. Buffett, doing his homework, looked past the temporary headwinds and analyzed the assets. He saw the newspaper itself, a dominant franchise in a major city. He saw Newsweek magazine. He saw several valuable television stations. Buffett conservatively estimated that the television stations alone were worth more than the entire $80 million price tag the market was putting on the company. In essence, Mr. Market was offering to sell him the TV stations for a fair price and then throw in the Washington Post and Newsweek for free. This was not a borderline call. This was a screaming, fat pitch bargain. While other money managers were panic selling to go to cash, consumed by the dismal headlines, Buffett calmly and methodically began to buy. He started accumulating shares in 1973, investing over $10 million, a significant sum for his partnership at the time. He wasn't just buying a stock. He was buying a piece of a phenomenal, undervalued business from a seller, Mr. Market, who was acting completely irrationally. He met with Katharine Graham to assure her of his long-term intentions. He saw himself as a permanent owner of the business, not a temporary holder of a stock certificate. The price continued to languish for a time, but Buffett was completely unperturbed. His anchor was his calculation of value, not the market's daily quote. Within a decade, that $10 million investment would be worth over $200 million, a 20-fold return. It became one of the cornerstone investments of Berkshire Hathaway, a testament to the power of acting rationally when everyone else is losing their minds. The underlying psychological principle at play during the Washington Post investment was Buffett's masterful override of recency bias and herd behavior. Recency bias is our natural tendency to give greater importance to recent events than to historic ones. In 1974, the most recent, most vivid data points were all negative. High inflation, the oil crisis, a tanking stock market, and political scandal. For the average investor, the future looked like a simple extrapolation of the recent past. Their mental forecast was for more of the same misery. This cognitive shortcut blinded them to the long-term durable value of a great franchise like the Washington Post. They couldn't see the forest for the trees because the trees right in front of them were on fire. Buffett, however, was able to mentally zoom out. He looked at decades of the Post's history, its unshakable bond with its community, and its fundamental economic characteristics. He saw the current crisis not as a new permanent reality, but as a temporary storm that would eventually pass, leaving the strong, well-built fortress of the Post standing. This directly ties into his immunity to herd behavior. The financial industry is a giant high-priced herd. The pressure to conform is immense. Imagine being a professional money manager in 1974. Your clients are calling you, terrified. Your colleagues are all selling. The most respected voices on Wall Street are predicting further doom. To stand apart from that stampeding herd and start buying takes almost superhuman conviction. It feels wrong. It feels dangerous. You are inviting criticism and risking your career if you're wrong. But Buffett's mental framework provided the necessary insulation. He wasn't listening to the herd. He was listening to his own analysis and having a quiet conversation with a deranged Mr. Market. He famously said, "You can't buy what is popular and do well." The Washington Post in 1974 was profoundly unpopular. The herd was selling it, and that is precisely why he was able to buy it at such a magnificent price. He was not just a contrarian for the sake of being a contrarian. He was a rationalist in a sea of emotionalists. He understood that the collective judgment of the herd is poorest at the extremes of euphoria and despair. The 1974 market was the extreme of despair, and he recognized it as the moment of maximum opportunity, a core lesson for any entrepreneur or investor looking to achieve significant portfolio growth. So how can we create a practical blueprint from this? The applied mental model is what we can call the panic shopping list. This is a proactive strategy, not a reactive one. You don't wait for the crash to happen and then try to figure out what to buy in the heat of the moment. By then, your own fear and the sheer chaos of the situation will likely paralyze you. The work must be done in advance, during times of calm. Step 1 is to identify your dream team of businesses. These are 10 to 15 wonderful companies that you would love to own a piece of if the price were right. They should have durable competitive advantages, strong balance sheets, and management you trust. These are companies like Coca-Cola, Apple, or whatever fits your circle of competence. For each company on this list, you must perform the valuation work we discussed earlier. Step 2 is to establish your panic price. For each company on your list, you determine the price at which it would move from a fairly valued company to a Washington Post in 1974 style bargain. This is your trigger price. It might be 30, 40, or even 50% below its current trading price. You write this down. You create a physical or digital document. Company A, intrinsic value, $150. Panic buy price, $90. Company B, intrinsic value, $300. Panic buy price, $180. This list is your roadmap in the fog of war. It's the product of your rational, calm mind, and you must pledge to trust it when your emotional, panicked mind takes over. Step 3 is to build your panic fund. This is a pool of capital, held in cash or short-term treasuries, that is specifically earmarked for deployment during a market crash. This is crucial. Opportunity is useless without the capital to seize it. Having this cash ready prevents you from having to sell existing holdings at depressed prices to fund new purchases. It is your war chest. When the inevitable market crash happens, and it will happen, your job is not to read the headlines or watch the financial news. Your job is to pull out your panic shopping list and your panic fund and see if Mr. Market is meeting your prices. Has Company A dropped to $90? If so, you buy. No emotion. No second guessing. You are simply executing a pre-planned strategy that was designed by your more rational self. This turns a terrifying event into a simple, mechanical process. It's how you can systematically emulate Buffett's behavior during the 1974 crisis and turn the next market crash into a wealth generation machine. The antithesis, the path of the 99%, is perfectly illustrated by the behavior of the masses during the 1973-74 crash. They engaged in what is known as, quote, capitulation. For months, as the market declined, they held on, hoping for a rebound. This hope gradually turned to anxiety, then to fear, and finally to outright panic. The final stage of a bear market is often marked by capitulation, where the last of the bulls finally give up and sell everything, regardless of price, just to end the pain. They are not thinking about the value of the Washington Post's television stations. They are thinking about making the red numbers on their brokerage statements stop falling. This is selling at the point of maximum pessimism, the polar opposite of Buffett's strategy. The psychological trap they fall into is extrapolating the present into the future indefinitely. In 1974, that meant assuming stagflation would last forever, that the stock market would never recover. This emotional forecasting is a deadly sin in investing. They also fall prey to the narrative fallacy. The story in the media was one of American decline, and they accepted that story as fact, projecting it onto every company, regardless of its individual strength. They sold their shares in world-class businesses right to Warren Buffett, not because the businesses were failing, but because the narrative was scary. The consequence is devastating. They lock in horrific losses, selling at the absolute bottom. And even worse, they are often so traumatized by the experience that they stay out of the market for years, missing the entire recovery. They sell at the bottom and only get the courage to buy back in years later, after the market has already soared, confirming the tragic cycle of buying high and selling low. This path doesn't just fail to build wealth, it actively destroys it. The direct financial connection of Buffett's approach in 1974 is a masterclass in value investing's impact on a portfolio. By purchasing assets at a significant discount to their intrinsic value, he established a massive margin of safety. This is a core Graham and Dodd concept. The margin of safety is the cushion between the purchase price and the estimated intrinsic value. When he bought the Post for a fraction of what its assets were worth, he had an enormous margin for error. Even if his valuation was a bit optimistic, even if the economy got worse before it got better, the price was so low that the risk of permanent capital loss was minimal. This is financial defense at its finest. From an offensive perspective, the connection is clear: massive capital gains. Buying an asset for $80 million that is worth, say, $160 million, and then watching it grow into a billion-dollar enterprise over the next couple of decades, is how you generate the kind of compound returns that build empires. The financial statement of Berkshire Hathaway was forever altered by this single decision, made in the depths of a panic. It wasn't just the profit from the Post itself, it was the cash flow that the Post generated for years to come, which Buffett could then redeploy into other undervalued opportunities. It demonstrates that the greatest financial returns are not earned by trading in and out of a fair-weather market, but by having the courage and discipline to allocate capital when blood is in the streets. This is the financial transformation promised by the Mr. Market allegory, turning widespread fear into personal, generational wealth. Our third pillar takes us forward in time to a single shocking day that has been seared into the memory of every investor who lived through it, October 19, 1987, better known as Black Monday. On that one day, the Dow Jones Industrial Average plummeted 508 points, a staggering 22.6% drop. To this day, it remains the largest one-day percentage loss in the index's history. The crash was swift, brutal, and terrifying. It was fueled by a confluence of factors, including rising interest rates, international tensions, and most notably, the advent of computerized program trading, which created a vicious, self-reinforcing cycle of selling. In the aftermath, the world felt like it was on the brink of another Great Depression. Fear was palpable. Mr. Market wasn't just depressed, he was having a full-blown psychotic breakdown on live television. For most investors, this was a catastrophe. For Warren Buffett, it was the ringing of an opportunity bell. He didn't just survive the crash, he used the ensuing pessimism to begin building one of his largest and most famous positions ever, his billion-dollar bet on the Coca-Cola Company. The foundational anecdote here is not about a single purchase on Black Monday itself, but about Buffett's mindset and actions in the months that followed. In the immediate panic of the crash, Buffett did what he always does: nothing. He famously told a reporter who asked what he was doing, "We're just answering the phone." He was calm. He was rational. He knew that the underlying value of the great American businesses had not fallen by 22.6% in a single day. A stock market crash is a liquidity event, a voting machine spasm, not a fundamental verdict on the weighing machine of business value. While others were staring at the wreckage, wondering if the financial world was ending, Buffett was sharpening his pencil and reviewing his shopping list. He had been a long-time admirer of Coca-Cola. He had been drinking it since he was a child and understood its business model with a clarity that few possessed. He saw a company with a simple, predictable product, a global distribution network that was virtually impossible to replicate, and a brand that was more of a cultural icon than a simple trademark. It was, in his words, a business with a durable competitive moat. In the years leading up to 1987, Coke's stock price had been bid up to levels that Buffett considered too high. He admired the business, but he wouldn't overpay for it. Mr. Market was simply too euphoric. Black Monday, and the subsequent market malaise, changed that. The crash knocked the froth off the entire market, including shares of Coca-Cola. Suddenly, Mr. Market, now riddled with anxiety and fear, was offering to sell him shares in this global powerhouse at a much more reasonable price. So over the next several months, starting in the latter part of 1987 and continuing through 1988 and 1989, Buffett began to buy. And he didn't just nibble. He bought with conviction, investing over $1 billion to acquire a stake that would eventually represent more than 6% of the entire company. People thought he was crazy. The memory of the crash was still raw, but Buffett was asking a simple question. Did the crash of 1987 change the amount of Coke people will be drinking in a year? In 5 years? In 10 years? The answer was obviously no. The desire for a simple, refreshing beverage was completely disconnected from the machinations of program trading on Wall Street. He saw the disconnect between the short-term price, which was driven by fear, and the long-term value, which was driven by billions of thirsty customers around the world. That $1 billion investment in Coca-Cola would, over the next decade, grow to be worth more than $13 billion. It was a classic Buffett masterstroke, made possible by viewing the market's panic not as a threat, but as his invitation to buy. The psychological principle that Buffett so expertly navigated here is the availability heuristic, coupled with a deep understanding of what truly drives business value versus what drives stock prices. The availability heuristic is a mental shortcut where we overestimate the likelihood of events that are more recent, more frequent, and more emotionally charged in our memory. In late 1987, the most available, vivid, and terrifying memory for every investor was the 508-point crash. This single data point loomed so large in the collective consciousness that it distorted all judgment. People couldn't help but see every stock through the lens of that crash, imagining it could happen again at any moment. This fear paralyzed them, causing them to demand a much higher risk premium for owning stocks, thus depressing prices across the board. They were suffering from a form of financial post-traumatic stress disorder. Buffett's mind, disciplined by the Mr. Market model, was immune to this. He was able to mentally set aside the dramatic, emotionally charged but ultimately irrelevant event of the one-day crash and focus on the less dramatic but infinitely more important fundamentals of the Coca-Cola business. He was asking questions about brand loyalty, unit case volume, and global growth prospects. The rest of the world was asking questions about portfolio insurance and trading curbs. They were playing two different games. Buffett's game was business analysis. The market's game was emotional reaction. By recognizing that the availability of the crash narrative in everyone's mind was creating a temporary pricing anomaly in a superb business, he could act with clarity. He wasn't trying to predict the market's next move. He was evaluating a business. This ability to separate the dramatic short-term noise of the market from the boring long-term signal of business performance is a psychological superpower. It is the very essence of value investing and a key component in any strategy for beating the market. The applied mental model that emerges from the Coca-Cola story is what we can call the 10-year test. It's a simple, powerful thought experiment you can apply to any potential investment, especially during a market panic. The blueprint is as follows. Step 1. Before buying any stock, and especially when considering buying during a crash, you must ask yourself this question. If the stock market were to close tomorrow and not reopen for 10 years, would I be comfortable and happy owning this business? This question radically changes your perspective. It forces you to stop thinking like a stock trader and start thinking like a business owner. You are no longer concerned with the next quarter's earnings report or the daily price fluctuation. You are forced to consider the long-term, durable characteristics of the enterprise. Step 2 is to analyze the business through this 10-year lens. Does the company have a product or service that people will still need and want in a decade? Does it have a strong brand, a patent, a network effect, or some other competitive advantage that will protect it from competitors over that time? Is the management team honest and capable people you would trust to run your business while you are away for 10 years? Is the balance sheet strong enough to weather any potential recessions during that period? This test immediately filters out the vast majority of speculative, low-quality, or fad-based investments. A meme stock might be exciting for 10 minutes. But would you be happy owning it if you couldn't sell it for 10 years? Almost certainly not. But a company like Coca-Cola? Buffett's answer in 1988 was a resounding yes. People would still be drinking Coke in 1998. The brand would still be powerful. The business was durable. Step 3 is to only buy companies that pass this test with flying colors. Your portfolio should be a collection of businesses that you would be content to own for a decade, even if you couldn't see a daily price quote. This is the ultimate antidote to the short-term emotionalism of Mr. Market. When a crash happens and the price of one of your 10-year test companies falls, it doesn't induce panic. It induces excitement. It's a chance to buy more of a wonderful business you want to own for the long haul, at a temporary discount. This mental model shifts your focus from price to value, from short-term speculation to long-term ownership, and provides the psychological stability needed for superior portfolio growth. It's a practical tool for entrepreneurs and retail investors alike to build a truly resilient and profitable portfolio. The antithesis to this approach, the path of the 99%, was on full display in the chaos of 1987. The 99% are not business owners, they are ticker watchers. Their entire sense of a company's worth is derived from its last traded price. Before Black Monday, a stock trading at $100 was a good company. After the crash, when it was trading at $77, it was suddenly a bad company. Nothing about the business had changed, but their perception, dictated entirely by Mr. Market's price, had been completely inverted. Their mistake was anchoring their idea of value to a recent high price. When that anchor was violently ripped away, they were left adrift in a sea of fear. The most common and destructive behavior was panic selling times the crash had already happened. Someone might have held on through the 508-point drop, but in the days and weeks that followed, the relentless media narrative of impending doom wore them down. They sold into the fear, locking in their losses. They confused the sharp drop in price with a permanent impairment of business value. The other side of this coin was paralysis. Many investors who didn't sell simply sat frozen, too terrified to do anything. They didn't have the conviction of a 10-year test to give them the confidence to buy the bargains that were being created. They just huddled and hoped. The result for both groups was the same. They missed the incredible buying opportunity that the crash presented. The market would go on to recover and hit new highs in the coming years, but the 99% were either out of the market entirely or too shell-shocked to participate. They let a once-in-a-generation opportunity, created by Mr. Market's psychosis, pass them by because they lacked the proper mental framework to interpret the event correctly. The direct financial connection of Buffett's Coca-Cola investment is a textbook case of how compounding works on an undervalued high-quality asset. When you buy a great business at a fair price, you can expect to earn a return that roughly mirrors the growth of that business's earnings over time. But when you buy that same great business at a significant discount, you get two sources of return. You get the return from the business's growth, and you get an additional explosive return as the price reverts from its depressed level back to a rational valuation. This is the double-barreled return that value investors seek. Buffett's $1 billion investment was generating massive returns simply as Coke's stock price recovered from the post-crash pessimism. But on top of that, the Coca-Cola business itself was growing rapidly around the world. The combination of these two factors, a re-rating of the stock's valuation multiple and the underlying growth of the business, is what turned $1 billion into $13 billion. On Berkshire Hathaway's financial statements, this showed up as a massive increase in the value of their marketable securities, which in turn drove the book value per share, Buffett's preferred measure of success, skyward. It demonstrates a critical financial principle. The price you pay determines your rate of return. By using the market's panic to pay a lower price for an identical asset, Buffett locked in a future return that was mathematically superior to those who bought before or long after the crash. It was a strategic financial move that directly translated the psychological principle of being greedy when others are fearful into billions of dollars of tangible capital gains. We now arrive at our fourth pillar, which takes us into the heart of the most terrifying financial crisis of our lifetime, the global financial crisis of 2008. This was not a one-day shock like 1987, nor a slow grind like the 1970s. This was a full-blown meltdown of the entire global financial system. The crisis, triggered by the collapse of the subprime mortgage market in the United States, cascaded through the world's largest banks and financial institutions. Lehman Brothers, a 158-year-old titan of Wall Street, went bankrupt. Giants like Bear Stearns, Merrill Lynch, AIG, and even Citigroup were on the brink of collapse. Credit markets froze solid. For a few weeks in September and October of 2008, it felt as though the entire ATM network of the world might shut down. The fear was not just that your stock portfolio was going down. The fear was that the fundamental plumbing of capitalism was breaking. Mr. Market was not just weeping or panicking. He was strapped to a gurney, foaming at the mouth, convinced the apocalypse was nigh. And in this moment of absolute world-ending terror, Warren Buffett did not run for his bunker. He picked up his pen and prepared to deploy billions of dollars, not as an investor, but as a lender of last resort. His actions during this period, specifically his deals with Goldman Sachs and General Electric, are perhaps the purest demonstration of being greedy when others are fearful in modern history. The foundational anecdote begins in late September 2008, just days after the Lehman Brothers bankruptcy sent shockwaves through the system. Goldman Sachs, arguably the most prestigious investment bank in the world, was in trouble, not because it was necessarily insolvent, but because in a world where no one trusted anyone, its funding was drying up. It was facing a crisis of confidence. The market was treating all banks as toxic. In this moment of desperation, Goldman's CEO, Lloyd Blankfein, made a call to the one person in the world whose name was synonymous with financial stability and trust, Warren Buffett. The deal they struck was legendary. Buffett, through Berkshire Hathaway, would invest $5 billion in Goldman Sachs. But this wasn't a simple purchase of common stock on the open market. This was a deal only Buffett could command, a deal born of extreme fear. He received $5 billion worth of perpetual preferred stock, which paid him a handsome 10% dividend per year. That's $500 million in cash, every year, guaranteed. On top of that, he received warrants giving him the right to buy another $5 billion worth of Goldman's common stock at a fixed price of $115 per share, exercisable at any time in the next 5 years. Just a week later, he did it again. General Electric, another bedrock of American industry, was facing a similar crisis of confidence in its massive financing arm, GE Capital. Buffett swooped in again, investing $3 billion in GE preferred stock, also paying a 10% dividend and also receiving warrants for common stock. These were not stock-picking decisions in the traditional sense. This was financial arbitrage on fear itself. Buffett was providing two things that the market desperately needed and that only he possessed in abundance: capital and credibility. The moment it was announced that Warren Buffett was investing in these companies, the panic surrounding them began to subside. His seal of approval was worth as much as the cash itself. He was not reacting to Mr. Market. He was stone-shaping the market's mood. He saw that the fear was so extreme, it was forcing even the strongest companies to accept terms that would be unthinkable in a normal environment. He knew that Goldman Sachs and GE were not going to disappear. They were integral parts of the American economy that the government would not allow to fail. While everyone else was selling their shares in these companies in a blind panic, Buffett was effectively becoming their senior financing partner, demanding and receiving terms that guaranteed him a fantastic return with immense upside and limited downside. The psychological principle at the heart of the 2008 deals is Buffett's mastery over ambiguity aversion. Humans have a natural aversion to ambiguity. We prefer known risks over unknown risks. We would rather take a 50-50 bet with a known probability of success than a bet where the probabilities are completely uncertain. The 2008 crisis was the definition of ambiguity. No one knew how bad the mortgage losses were. No one knew which banks were solvent. The entire system was a black box of unknown risk. This paralyzing uncertainty is what caused the credit markets to freeze. The natural human reaction to extreme ambiguity is to flee to safety, to sell everything and hold only the most certain of assets, like U.S. Treasury bills. This is why the stocks of perfectly good companies were being sold off indiscriminately alongside the truly troubled ones. Buffett, on the other hand, thrives in ambiguity. His mental model allows him to cut through the fog of uncertainty by focusing on a few key variables. His thought process wasn't, what is the exact exposure of Goldman Sachs to every subprime mortgage derivative? That's unknowable. His thought process was, is Goldman Sachs too important to the financial system to fail? Is the U.S. government going to let the entire banking sector collapse? Is this a business that will be around and profitable in 5 or 10 years? By focusing on these high-level, almost certainty-based questions, he could look past the short-term ambiguity that was terrorizing everyone else. He wasn't betting on the subprime market. He was betting on the long-term survival and necessity of the American financial system. Furthermore, he structured his deals to protect himself from that ambiguity. The preferred stock gave him a guaranteed 10% return, his downside protection. The warrants gave him all the upside if and when the ambiguity cleared and the company recovered. This ability to remain rational and to structure deals that are robust to uncertainty is a psychological skill that separates the master investor from the amateur. It is a cornerstone of advanced wealth management and executive decision-making under pressure. The applied mental model here is the fortress balance sheet strategy. both for your personal finances and for your investment analysis. This is a blueprint for preparing for and capitalizing on a crisis. Step 1 is to build your own personal fortress. This means having a significant portion of your net worth in safe, liquid assets, cash, before a crisis hits. Buffett could make those deals in 2008 because Berkshire Hathaway was sitting on tens of billions of dollars in cash. He had the dry powder. For a retail investor, this means having a fully funded emergency fund and additional cash reserves set aside specifically for investment opportunities. It means avoiding excessive leverage, like margin loans, which can force you to sell at the worst possible time. You must be financially robust enough to withstand the storm and have the resources to go on the offensive when the opportunity arises. Financial freedom isn't just about having assets, it's about having liquidity and resilience when everyone else is over-leveraged and fragile. Step 2 is to apply this fortress lens to your stock picking. When you analyze a company for your panic shopping list, pay special attention to its balance sheet. How much debt does it have? Can it easily cover its interest payments? Does it have a healthy cash position? Companies with fortress balance sheets can survive a deep recession without needing to dilute their shareholders by issuing new stock at depressed prices, or, even worse, going bankrupt. They can play offense during a downturn, buying back their own cheap stock or acquiring weaker competitors. In 2008, the companies with the most debt and the weakest balance sheets were the ones that got wiped out. The ones with fortress balance sheets, like Berkshire Hathaway, were the ones who could dictate terms. Step 3 is to combine your personal fortress with your list of corporate fortresses. When the crisis hits, you use your cash to buy shares in the high-quality, financially strong companies that have been unfairly punished by the market's indiscriminate selling. You are, in your own way, providing liquidity to a panicked market, just as Buffett did. You are buying the strongest assets when they are on sale because the neighborhood they are in is temporarily on fire. This strategy, prepare your own fortress, identify other fortresses, and act when the crisis provides the opportunity, is the most reliable way for an individual investor to emulate Buffett's 2008 playbook and achieve extraordinary portfolio growth. The antithesis, the path of the 99%, was tragically clear in 2008. The most common mistake was the use of excessive leverage. In the years leading up to the crisis, people were borrowing against their homes, using margin in their brokerage accounts, and generally living in a state of high financial risk, believing the good times would never end. When the crisis hit and asset prices collapsed, this leverage became a death sentence. They received margin calls, forcing them to sell their stocks at the absolute bottom to cover their loans. Homeowners who were underwater on their mortgages faced foreclosure. They were forced sellers in a buyer's market, the very definition of financial helplessness. They were the people on the other side of Buffett's trades, selling their assets, not because they wanted to, but because they had to. Even those who were not over-leveraged fell into the trap of selling everything to stop the bleeding. The narrative of a complete systemic collapse was so powerful that it seemed like the only rational thing to do. They sold their blue-chip stocks, their index funds, everything. They went to cash and then sat there, paralyzed by fear, for years. They watched from the sidelines as the market, fueled by government intervention and the eventual economic recovery, staged one of the most powerful bull market runs in history. Their mistake was a failure of imagination. They could not imagine a world beyond the immediate crisis. They confused a severe but ultimately cyclical downturn with a permanent apocalyptic event. This failure to differentiate between the temporary and the permanent is the defining feature of the 99% path, and it is a recipe for the permanent destruction of wealth. The direct financial connection of Buffett's 2008 deals is perhaps the most brilliant example of financial engineering in a crisis. Let's look at the numbers. The preferred stock gave him a high-yield, low-risk income stream. That 10% dividend from Goldman and GE was like a high-coupon bond, but with the upside of an equity investment. This cash flow, totaling $800 million per year from these two deals alone, massively boosted Berkshire's income during a time when other companies were seeing their earnings collapse. This is the financial power of becoming a capital provider in a capital-starved world. But the real genius was in the warrants. The warrants were essentially free, long-term call options. They cost him nothing to receive, but gave him the right to all the upside above a certain price. When Goldman Sachs stock recovered, as Buffett knew it would, his right to buy shares at $115 became immensely valuable. In 2013, Berkshire exercised those warrants, netting a profit of over $3 billion. The GE deal produced similar multi-billion-dollar gains. The financial impact was staggering. He had created a structure that gave him bond-like safety and income on the downside, and massive equity-like capital gains on the upside. It was a financially asymmetric bet of historic proportions, transforming the market's terror directly into billions of dollars of shareholder value for Berkshire Hathaway. A masterclass for any entrepreneur or investor on how to structure deals when you have the leverage of being the only person with cash in a panic. Our fifth and final pillar brings us to the most recent global crisis, the COVID-19 pandemic of 2020. This event was unique. It wasn't a slow-moving economic problem or a financial crisis born on Wall Street. It was a biological crisis that forced a sudden and unprecedented global economic shutdown. In a matter of weeks, in February and March of 2020, the stock market fell by more than 30%. The speed and severity of the collapse were breathtaking. Airlines were grounded, restaurants were closed, and entire industries were put on life support. The level of uncertainty was perhaps higher than even in 2008. Mr. Market was in a state of shock and terror, processing a threat that no financial model could have predicted. All eyes turned to Omaha. The world waited to see what masterstroke Warren Buffett, now 90 years old and sitting on a cash pile of over $130 billion, would pull off. They expected a repeat of 2008, a series of grand company-saving deals. And what did Buffett do? For the most part, he did nothing. And in his inaction, he provided the ultimate lesson in the discipline of the Mr. Market principle. The foundational anecdote of this period is not a story of a brilliant purchase, but of a disciplined sale and a patient wait. As the crisis unfolded, Buffett made one major move. He sold Berkshire Hathaway's entire position in the four major U.S. airlines, Delta, American, Southwest, and United, for a loss of several billion dollars. At Berkshire's annual meeting in May 2020, held virtually in an empty arena, he explained his reasoning. This was a crucial nuance of his philosophy. He didn't sell because the stock prices had gone down. He sold because his assessment of the intrinsic value of the airline business itself had fundamentally changed. The pandemic, he concluded, posed a genuine existential threat to the industry. The future of air travel was now subject to a range of outcomes that were dramatically worse than when he had purchased the stocks. In his judgment, the world had changed for airlines, and the moat he thought they had was no longer intact. This was not panic selling. This was a rational reassessment of long-term business prospects in the face of new, game-changing information. Beyond that, he largely sat on his hands. He didn't make a big splashy investment in the teeth of the March panic. He was widely criticized for this. Pundits claimed he had lost his nerve, that he was too old, that he had missed the bottom. But this criticism fundamentally misunderstood the Mr. Market principle. The principle does not state that you must buy when your partner is panicked. It states that you can buy if he offers you a price that makes sense for a business you understand and want to own for the long term. In the whirlwind of March 2020, with the government preparing unprecedented stimulus packages, the range of outcomes was too wide. The prices were changing too fast. He did not feel he was being offered the same kind of fat pitch he saw in 2008, so he waited. His patience was rewarded later in the year, long after the initial panic had subsided, when he made a multi-billion-dollar investment in 5 Japanese trading houses and a large investment in the pharmaceutical industry. The lesson was profound. The Mr. Market allegory gives you the option to act, not the obligation. Sometimes the smartest move is to simply ignore your frantic partner's offers, both high and low, and wait for a moment of true clarity. The underlying psychological principle demonstrated by Buffett in 2020 is the resistance to action bias. Humans are hardwired for action. When faced with a crisis or a high-stakes situation, our instinct is to do something. Anything. Sitting on our hands feels passive, irresponsible, and weak. This bias is especially strong in the world of finance, where activity is often conflated with productivity. Traders trade, managers manage. Doing nothing is seen as a failure of conviction. The pressure on Buffett, with his mountain of cash and the world watching, to make a bold move was immense. Every headline was questioning his inaction. This is a powerful social pressure that causes many investors to make ill-conceived moves just for the sake of being active. They feel they have to put money to work or catch the bottom. Buffett's behavior was a masterclass in resisting this bias. His framework is not about constant activity. It's about occasional high-conviction action. He is, as he describes it, a no-called strike investor. In baseball, a batter has to swing at any pitch in the strike zone. In investing, you can stand at the plate and watch thousands of pitches go by. Overvalued companies, industries you don't understand, uncertain situations, and it costs you nothing. You can wait for the perfect, slow, fat pitch right down the middle before you swing. In 2020, during the initial crash, he didn't see his pitch, so he didn't swing. This discipline, this ability to equate patience with a strategic position, is an incredibly rare and valuable psychological trait. It allows you to conserve your two most precious assets, your capital and your mental clarity, waiting for the moment of maximum advantage. It's the final, and perhaps most difficult, level of mastering the Mr. Market game. The applied mental model from this chapter is the non-action protocol. It's a system for knowing when to sit still, which is just as important as knowing when to act. Step 1 is to explicitly define the conditions under which you will not act. This means creating a set of personal investing rules. For example, I will not buy a company I cannot explain to a 10-year-old in 2 minutes. I will not invest in a sector undergoing massive, unpredictable technological or regulatory change. I will not make an investment decision within 24 hours of a major market-moving news event. These rules are your psychological circuit breakers. They prevent you from getting swept up in a narrative or a panic and making a rash decision based on action bias. Step 2 is to embrace cash as a strategic position. Most investors view cash as a drag on returns, a non-working asset. This is a mistake. Cash is not just a zero-return asset. It is a zero-risk call option on future opportunities. Holding a significant cash position, as Buffett does, is not a sign of fear. It is a sign of discipline and patience. It is the price you pay for the ability to act decisively when a true fat pitch appears. You must reframe cash in your mind from a lazy asset to a strategic weapon in waiting. Step 3 is to practice the art of benevolent neglect. Once you have bought a collection of wonderful businesses that pass your 10-year test, you don't need to check their prices every day. You don't need to react to every headline. You can let them be. The more you tinker, the more you trade, the more likely you are to be swayed by Mr. Market's moods and do something foolish. Having a non-action protocol, your rules, your cash position, and your willingness to let your investments compound in peace is the ultimate safeguard against the psychological pressures of a volatile market. It is the wisdom that complements the courage of buying in a panic. The antithesis, the path of the 99% in 2020, was a whirlwind of emotional and frantic activity. In the initial crash, we saw the familiar pattern of panic selling. People sold everything, convinced the global economy was shutting down forever. But then, as the government unleashed trillions of dollars in stimulus and the market began to rebound with shocking speed, a new, equally dangerous emotion took hold: fear of missing out, or FOMO. People who had sold at the bottom watched in horror as the market soared without them. Driven by this new anxiety, they piled back in, often buying speculative, low-quality story stocks that were rising the fastest. This led to the explosion of meme stock trading and a casino-like atmosphere in parts of the market. They whipsawed from extreme fear to extreme greed in a matter of weeks. They were completely at the mercy of Mr. Market's manic mood swings, selling at the bottom out of fear and buying back near the top out of greed. This is a recipe for guaranteed underperformance. They lacked the patience of a non-action protocol and were driven by the need to do something at every turn, ensuring they were on the wrong side of the emotional wave at every point. The direct financial connection of Buffett's 2020 strategy is one of capital preservation and option value. By selling the airlines, he prevented a potential permanent loss of capital in an industry whose future had become dangerously uncertain. The first rule of investing is don't lose money, and his sale was a direct application of that rule. On a financial statement, this preserved billions of dollars of capital that would have otherwise been at severe risk. His decision to hold his massive cash pile had an even more profound financial impact. While that cash earned very little interest, its option value was enormous. The existence of that $130 billion gave Berkshire Hathaway immense financial flexibility and stability in a world starved of both. It allowed the company to weather any storm and gave it the power to act on any opportunity that met its stringent criteria. While it didn't lead to a dramatic 2008-style profit in the short term, it ensured the long-term invincibility of the enterprise. It demonstrates the ultimate financial wisdom. The return of your capital is more important than the return of your capital. By prioritizing the preservation of his fortress and refusing to be rushed by Mr. Market's panic, Buffett ensured that Berkshire would live to fight and win another day. A final, powerful lesson in turning the market's mood into your long-term advantage. You have just spent this time absorbing a mental framework that is responsible for the creation of one of the greatest fortunes in human history. You have moved beyond the simple, foolish questions of, what stock should I buy? Or, is the market going up or down? And have elevated your thinking to the level of strategy, psychology, and discipline. You now possess the allegory of Mr. Market, an emotional shield that can protect you from the madness of crowds and the destructive whispers of your own primal fears. You understand that price is not value, that panic is opportunity, and that disciplined inaction is often the most powerful action of all. This is not just a piece of trivia about a famous investor. It is a powerful tool, a new operating system for your financial mind that, if applied, can fundamentally alter your destiny. But what you must understand is that this tool, as powerful as it is just one piece of a much larger, interconnected mental arsenal. Warren Buffett's success is not the result of a single trick, but of a latticework of mental models, each supporting and reinforcing the others. The Mr. Market framework tells you when to buy, but what about what to buy? The concept of a circle of competence is the critical link that ensures you are only shopping for businesses you truly understand. And how do you value those businesses? The mental models of margin of safety and earnings power value are the specific tools needed to calculate that all-important anchor of intrinsic value. You have just mastered a crucial piece of the map, the piece that governs your emotional response to the terrain. But it is still just one piece. The true power, the kind of power that builds lasting, generational wealth, comes from connecting these models into a coherent, seamless whole. The video that is now appearing on your screen is not an accident. The algorithm has identified it as the next logical step in your journey, the missing link. Think of what you've learned today as the foundation of a great fortress. That next video is the blueprint for the watchtower, the piece that connects what you know about market psychology to the specific analysis of what makes a business truly great. Clicking on it is not about passively watching another piece of content. It is an active choice. It is a decision to continue your ascent, to add another layer to your emotional shield, to complete the mental arsenal required to navigate the complex world of finance not as a victim but as a commander. The average person will stop here, satisfied with a single insight. But you are not the average person. You have invested your time to get this far. The question is, are you ready to continue the journey and claim the full power of this way of thinking? The next piece of the map is waiting for you. Click and continue your transformation.